Too often, reward takes the front seat. You'll hear friends bragging about their big stock wins, but it's really important to ask, what was the risk that they took to get that reward? There are a lot of other flaws. People will skew reality. They're more likely to talk about their winners than their losers, and that can create issues. But today, I really want to focus on the risk side of the equation, or multiple equations. That's what really sets apart novice and experienced investors. When investing, it's vital to take and improve your measurements of both risk and reward. Because if you take on too much risk, you might not be able to recover. To really put this in perspective, let's say you put all of your money in just one investment. Now that one investment drops 10%. Just to get back to where you started, your initial investment, it'd require an 11% gain. Now let's say you had a 20% loss. It'd require a 25% gain just to get back to where you started, or break even. Now a 50% loss would require a 100% gain. And going even further, a 90% loss would require a 900% gain. And you'd have to take on a lot more risk just to see those higher returns. Now, one simple way to manage the risk of a catastrophic loss is to diversify. It's the proverbial, don't put all your eggs in one basket. And hopefully you're already aware of the benefits of diversification. If you're not, you can check out one of my past videos on diversification and why Warren Buffett accepts his ignorance. So even if you are familiar, you'll probably still learn a few new things in that, and I'll drop a link down in the description below. Today instead, I want to really focus on risk measurement and how time frame impacts risk. I know it's a super exciting topic. Well, I at least find it to be exciting, and there is going to be one key takeaway from this short video that could easily mean the difference of $100,000 plus in your portfolio down the road. Now, before we dive in, I'd really appreciate it if you just tap the like button down below, as well as subscribe. And if you have already, thank you very much for sticking around. This is just really a side passion project, and I put many hours in over most weekends trying to compile and share what I find to be the most unique and useful ideas. So let's go ahead and dive in. In the investing world, standard deviation is a common measurement of risk. It's a statistic that measures the dispersion of data relative to a mean, or its mean. So generally, the higher the standard deviation, the riskier we can expect the investment to be going forward. And of course, past performance is no guarantee of future returns. There are reversals and, on occasion, new normals. Statisticians sometimes call these stationary or regime changes. But in general, the trend is your friend. In fact, past data and trends are the only things we have to really make informed decisions going forward. But there's one key caveat, or one key here. It's good to look at more inclusive, less biased data sets and trends over different time frames. Now, I don't want to go into statistics jargon, like what's the difference with unimodal platycritic distribution and leptokurtosis, thanks CFA exams. Instead, I just want to shed light on risk measurement in general, or more so risk to reward measurements. And I think I've found a simple yet powerful way to do that. Each risk to reward measurement or tool has different pros and cons. To measure different investment or portfolio returns, you could use Sharpe or Sortino ratio, Trainer measure, or many others. For the most part, the reward side of all these measurements is the same. It's usually an average of returns over the time frame. And on the other hand, the risk side of these equations is what differs the most due to more flaws with risk measurement. Now, using standard deviation alone doesn't always give the best guidance. There are some or many assumptions behind it, and the example I'm going to put up on your screen reveals some issues. So with this, Portfolio A has much lower standard deviation than Portfolio B. So some risk-averse investors might choose Portfolio A, but Portfolio B has much higher risk-to-reward ratios. And in most of the years, Portfolio B has outperformed by a wider margin. I hope this kind of helps show why it's important to use different risk to reward measurements. And also learning more about risk management can just have a massive impact on your portfolio over time. And I just want to leave you with kind of one final thought or takeaway here. The general wisdom is that government bonds are safer than stocks, but there's a big assumption here, and most people overlook it. Government bonds are only safer than stocks in the short run, not the long run. It's a very important distinction. Because if you have multiple decades before tapping into your investment, like many retirement accounts, it's riskier not to invest in stocks. That's assuming you want to maximize your returns. And you can have a staggered drawdown period over many years. So even if you're retiring soon, this can make sense. You're not going to you're not going to pull out all of your investments at once. So with this in mind, that's kind of why I've built up a big emergency fund, and now I've started buying more stocks over the past few years. I'm hoping to reach an allocation of 90% plus, or of over 90% stocks in my total portfolio. And outside of collecting dividends, I don't plan on touching those investments for a few decades. Sure, it's not going to be fun watching the big swings or the risk in the short term in any given year, but I know in the long run, it has a very high probability of higher returns. And when using more appropriate long-term risk measures, it'll also have much higher risk to reward. So I hope this got you thinking a little bit. Risk is really important, so look at both risk and reward. It'll make a big difference with your investing, and it can apply to many other areas of life as well. If you have any questions, please drop them down below, and please let me know just any feedback in general. And if you could, just tap the like button down below as well as subscribe. Thank you.